Welcome back. We're doing a deep dive today into something that's, well, a bit of a financial mystery.
Hmm.
We're looking at the London property market because it really seems to be completely disconnected from the rest of the UK.
It really is. It's a classic two-speed market right now.
Right. So while the country sees prices going up a bit, London is, well, a totally different story. Okay, let's unpack this.
And the best place to start is with the headline numbers. The latest ONS data shows the average London house price in October was about £547,000.
Okay.
But here's the kicker. That's a drop of 2.4% year on year. And at the same time, the rest of the UK actually went up by 1.7%.
That is just a huge disconnect, isn't it? And our sources show it's not a small dip either. We're talking 18 of the 33 London boroughs saw prices actually shrink.
And that's the key part. It's not the cheaper areas dragging the average down.
No, exactly. It's the super prime, the most expensive postcodes that are really leading the fall.
Some of the specific numbers are just jaw-dropping.
They really are.
Yeah.
Take the City of London, an 18% fall. And Kensington and Chelsea, KNC, that dropped by a staggering 16.5%.
Wow. And in real money, what does that even mean for a property there?
Well, think about this. KNC's average price is now 1.19 million. That's its lowest point in more than a decade.
And it was peaking at, what, 1.6 million?
That's right. So that's a value drop of over £400,000 on a single property. It's just wild.
So if that much capital is fleeing the very top end, where is it all going?
Right.
Well, it seems to be flowing directly into the capital's, more affordable areas. Demand is strongest there, places like Havering, for example.
Havering, so Romford and areas like that.
Exactly. Prices there actually rose 5.3%. And you see boroughs like Waltham Forest, Lewisham, their prices hit all-time highs this autumn. It's clearly a tale of two Londons.
Okay, so what's fascinating here is why? Why this dramatic split?
One analyst, Tom Bill, suggests that these prime areas are just much more susceptible and sensitive to political risk.
Political risk
Yeah.
and taxes, I assume?
And taxes, definitely, especially things like stamp duty, where the costs just get enormous on a multi-million-pound property.
But why is an overseas investor parking wealth in a £3 million flat so much more worried about political risk than, say, a first-time buyer? What does that risk actually look like?
It's the fear of a changing tax landscape. A perfect example is the new policy announced by Chancellor Rachel Reeves, the mentioned tax surcharge.
And this is totally different from stamp duty, isn't it?
Completely. Stamp duty is a one-off transaction fee. This new surcharge is an annual wealth tax. It specifically targets properties valued over £2 million.
And the rates are quite pointed. It starts at a yearly fee of £2,500 for homes between $2 and $2.5 million.
And it escalates up to £7,500 for properties worth $5 million or more.
The central government expects this to raise $400 million by 2029-30. That figure might not be huge nationally, but it sends a very powerful political message, doesn't it?
A huge message about who's going to bear the burden of new revenue. Mark von Grunter noted that just the prospect of a new Labour government has already had a significant impact on these values.
Because it signals that kind of policy shift.
Exactly. And you have to put this in a bigger context. Richard Donald pointed out that London prices, they've essentially gone nowhere since the 2016 Brexit vote.
Right, that was that boom-bust sea change moment for London as a place to do business. So you've got stagnation since 2016, and now this targeted tax squeeze. So what does this all mean for the immediate future if you're looking to invest?
Well, the outlook isn't exactly booming for the capital.
No. Rightmove research suggests London prices will, well, they'll barely move in 2026. They're projecting just over a 1% rise.
Which again is way below the 2 to 3% increase expected across the rest of the UK.
It's still lagging behind.
Which brings us to a final provocative thought for you to consider. If experts are arguing that London has lost some of its appeal internationally since Brexit,
And if new, recurring taxes are now specifically targeting high-value assets.
how fundamentally is London being redefined, not just as a place to live, but as a global investment haven? If political risk and targeted taxation are the new norms, what other new risks might you be watching for if you were investing millions in the capital?